Good evening. My name is NGWINO, and I'm going to present you the questions and answers which are usually asked on the position of financial management specialist, directors of finance and administration units, and many others related to the financial management. Let's start. Let's start with financial statement and analysis. These are questions related to the financial statements and financial analysis. The first question is asked: a techniques uses in comparative analysis of financial statement is graphical analysis, preference analysis, common size analysis, returning analysis. The right answer is a common size analysis is the one which is used to analyze financial statement. Now, second question. Net income available to stockholders is USD 125, and the total asset are 1,096. Then the return on common equity would be 0.11%, 11.40%, 0.12 times 12%. Yeah, here the right answer is B. And is found by taking the available stockholders 125 divided by total asset and multiplied by 100. The third question, price per share is 30 and the earning per share is 3.5. Then price for earning ratio would be, the price earning ratio is, the right answer is A, 8.57 times. And this is obtained by taking the price per share divided by the share, the earning per share, and obtain 8.57. The following question, price per share is 25 and cash flow per share is 6. Then cash flow ratio would be, right answer is B, which is obtained by taking 25 price per share divided by the cash flow per share, which is 60, and we get 4.16 times. The next question is low price for earning ratio is results of raw riskier firm. Question 6, profit margin is 4.5%, asset turnover 2.2 times, equity multiplier is 2.7 times, then What is return on asset? Here the right answer is A. Then this is obtained by 4.5 times 2.2, then multiplied by 2.7 is how we can calculate return on asset. Question 7. Formula such as net income available for common share stockholders divided by total asset is used to calculate. This formula is used to calculate return on total asset. Question number 8. Price per ratio is divided by cash flow per share ratio, which is used for calculating. This formula is used to calculate cash flow to price ratio. This is the right answer. Question 9. Techniques used to identify financial statement trends are included common size analysis, yes. Percent changes analysis, yes. Returning ratio analysis, no. The right answer is A and B. Net income available to stockholders is 150, and total asset are 2,100. Then return on total asset will be, the right answer here is B, which is obtained by taking the net income available 150 divided by total asset 2,100, then multiply by 100. The question 11. A formula such as net income available to common stockholders divided by common equity is used to calculate return on common equity. Companies that help to set benchmark are classified as benchmark companies. A total asset divided common equity is a formula used for calculating equity multiplier. Question 14. Price per share divided by earning per share is a formula for calculating price-earning ratios. Question 15. Profit margin multiplies asset turnover multiplies equity multiplier is used to calculate return on equity. The next, company, low earning power and high interest costs causes financial changes which have a high return on asset. Next, ratio which let firm's stock to its book value per share, cash flows and earnings are classified as market value ratio. Next, an equation in which total assets are multiplied to profit margin is classified as D-point equation. Next, price earning ratio and price by cash flow ratio are classified as market value ratios. A return on asset is 5.5%. Total asset 3,000. A common equity 1.050. Then return on equity would be 15%, which is obtained by is obtained by $3,000 divided by 1,050 times 5.5. Okay. Question 21. Return on asset. Yeah, this is the same as the question number 20. High price to earning ratio shows companies what? Companies high growth prospect. A return on asset is 16 and equity multiplier is 2.5, then the return on equity will be 16%. And it is obtained by $6.7 times 2.5, and you get this answer. Next question. A process of comparing companies' results with other leading firms is considered as benchmarking. Next question. An equity multiplier is multiplied to return on asset to calculate a return on asset. Next question. Yeah, we come to the other topics, which is capital budgeting, evaluating cash flows. Capital budgeting, evaluating cash flows. Yeah. First question. A project whose cash flows are more than capital invested for a rate of return, then the net present value will be a positive. In mutually exclusive projects, project which is selected for comparing with other must have a high net present value. Next question. Relationship between economic value added and net present value is considered as direct relationship. Fourth question. Uncovered costs at starts of the year is 200. Full cash flow during recovered year is 400. And prior year to full recover is 3. Then payback would be, this is how to calculate a payback. A payback will be, in this method of calculating a payback, we have to take a full cash flow during recovery year, which is 400, divided by an uncovered cost at starts of the year, which is 200, and add the year to full recovery, and then we will get a payback period. Yeah, let's do it. 400 divided by 200, we get 2. No, sorry. We will take an uncovered cost at the start, which is 2. $200 and divided by a full cash flow during the recovery year, which is 400, and we get 0.5. Then add a 3. Add a 3. We get 3.5, which is B. Yeah, this question sometimes is tricky. If you made a mistake, you get an answer, but is wrong an answer. Have to be careful. In capital budgeting, positive net present value results in a positive economic value added. Next, an uncovered cost at the start of the year is divided by the full cash flow during recovery year, then added in a prior to full recovery for calculating payback period. This is the formula used for this question 4. Yeah, is this. Question 7. In a cash flow analysis, 2 projects are compared by using common life is classified as transactional approach. No. Replacement chain approach, yes. Common life approach, yes. B and C is the right answer. Next. Other factors held constant, but lesser projected liquidity is because of a greater payback period. Question 9. In a capital budgeting, an internal rate of return of a project is classified as its internal rate of return. Next, in independent project evaluation, results of internal rate of return and net present value lead to the same decision. When we use either internal rate of return or present value, we take the same decision by considering the project with a positive answer. Next question. In internal rate of returns, discount rate which forces net present value to become zero is classified as the internal rate of return. Next question. Projects which are mutually exclusive but different on scale of productions or time of completion, then the net present value of method. Next question. A graph which is plotted for projected net present value and capital rates is called net present value profile. A modified internal rate of return is considered as present value of costs and is equal to present value of terminal value. A set of projects or sets of investment usually maximize firm value is classified as optimal capital budgeting. Question 16. A point where profile of net present value crosses horizontal axis at plotted graph indicates project's internal rate of return. Question 17. Modified rate of return and modified internal rate of return will exceed cost of capital if net present value is positive. Payback a period in which unexpected cash flows are discounted with help of projects. Cost of capital is classified as discounted payback period. In capital budgeting, a negative net present value results in negative economic value. Number of years forecasted to recover an original investment is classified as payback periods. Question 21. In capital budgeting, terms of bonds which has great sensitivity to interest rate is a long-term bonds. Question 22. Process in which managers of a company identifies projects to add value is classified as capital budgeting. Next question. A discount rate which equal to present value of terminal value to project cost present value is classified as modified internal rate of return. Next question. A project whose cash flows are sufficient to repay capital invested for a rate of return, then net present value will be zero. Present value of future cash flows is 2,000. Okay. And an initial cost is 1,100. What is the index, the profitability index. The profitability index will be get by taking present value of future cash flows, which is 2,000, and divided by initial investment or initial cost, which is 1,100, and we will get 1.82. Next question. Profitability index is in capital budgeting is used for evaluating a project. Other factors held constant, greater project liquidity is because of shorter payback period. Number 28. In capital budgeting, a number of non-normal cash flows have internal rate of return are multiple. The last question for this session is an internal rate of return in capital budgeting can be modified to make it representative of a relative costs. Thank you for watching. This is the end of my today's session. We will meet next time, and I wish you the success in this new style of examining, and I hope together we will reach a good decision. And I wish you the success, hopefully, for the different positions which are published on the Smart HR, which is a system used by MIFOTRA to manage its public employee. We will get the job by following my videos, by following my different questions and answers on the accounting position, on directors of finance, planning and monitoring evaluation, and so on. We will help each other. Thank you for watching.